everyone. Welcome back to another episode of Creating a Village. I'm your host, Millie, here to help nurture the village within you. And today we have a special guest with us. If you could please introduce yourself.
Absolutely. My name is Manker Biah, and I am on a mission with financial literacy. Thank you for having me.
Oh, period. Thank you so much for coming on. I love that you said you're on a mission for financial literacy. Can you talk a little bit about how you got into that?
Yeah, for sure. I got on this path because I needed the help. I needed a
Mm,
community, the back end. Um, Growing up, I definitely didn't have it at all. I my social circle or friends, we didn't really talk about money like that in the
mm,
right sense. Um, so it took me a while to get into actual career field. And once I got in the career field, I felt like, okay, now, I should be able to handle money better because I'm in a good
yeah.
career field. And yeah, no, that wasn't it. I was nowhere near it at all. So that's when, I realized, okay, I needed to understand money. Okay, because growing up, my family was like, hey, we all heard it, go to school, get a good job, situation,
Hmm.
right, Bill? And, once you finally get it, you go to school, you get that good job, you're like, okay, am I wealthy yet?
Yes.
Oh, no, no, I'm not wealthy yet. What's the problem? What am I doing wrong with life, right? And that's when I started, kind of searching for the answer. And honestly, I found that answer a little over 5 years ago. I want to say close to 6 years now. And
Mm.
I've been on that journey now and sharing my journey with other people, my experience and information that I'm learning and I have been learning and applying.
Okay. That's amazing. I definitely relate to that because growing up, my dad would always tell me, "Oh, Jada, you're so good at saving. You have like really good money habits." But it was just when I was growing up, I didn't have a lot of things that I wanted at the time, so I was saving my money. But then when I got money and I had things I wanted, I was like, "Where is my money going?" Yes, so that is definitely a thing, like not knowing exactly how to have those good money habits. And then when you get money, you're like, well, I thought I had the habits, where'd they go? So, yeah. Wow. So I know you're in insurance, right? So how did you get into insurance?
Really good question, actually. It's one of those I stumble within it, getting on the
Mm,
journey, and me finding out really within the journey of understanding finance that insurance is a huge part, right? It's a
mm,
huge part, and we don't even think about it because we literally insure everything that we has some type of real attachment to, right? Like our cell phones,
yeah.
right? Nowadays too, you get that $1,000 or $1,500 iPhone. First thing you want to do is put insurance on it right away.
Hmm.
And because if anything, you want to be able to replace that right away. But of course, me getting into finance and trying to understand, what's going on with my dad and why our credit was terrible, things of that nature,
Mm,
I realized that insurance is a huge part of really honing my finances, and I dove into it and realized that it's an industry that a lot of people have a lot of misconception. The whole
mm.
outside population is like, oh, insurance is for death. Yes, it is, right? But it's also for so much more. And that's how I got into it. And I've been definitely learning a lot each and every day.
Okay. Wow, what would you say is one of the um I don't know, the most interesting things you've learned about like insurance in terms of wealth building, I guess? Because how you were saying insurance is for death, but there's a lot more to it.
No, absolutely. It's definitely a lot more to it. It's honestly life insurance or insurance in general. Once we do understand it, and it correlates to understanding our responsibility in life,
Mm,
right? Once we understand our responsibility, we understand how much we are valued, and we start really adding, quote unquote, as baby would say, put some respect on it. You start putting some respect on your name, right?
yeah.
And once you understand your value, you could protect your value, or you could treat yourself to a certain caliber, right? And the type of insurance that you carry determine how much respect you got for yourself and how much you see yourself worth in the next, I don't know, years or now, right?
Mm,
And you could also utilize it however way you know, because you have been educated and you know exactly what you got, if that makes sense.
okay. Yeah, that makes sense. Um, so I'm new to insurance. Haven't looked into it a day in my life. Um, how would one start learning about insurances? I guess maybe I guess we can stick to life insurance for now. Um, so like how would I jump into this world?
Well, that's first of all, that's really a good question. And the first thing is figure out what your goal is, right? If
Mm,
your goal is to really secure your finances, understand what your responsibility is. When you say, and because especially with our audience, right? Our community right now, we would say we're young community, right?
mm,
And most young community, they ain't really thinking about, oh, I don't have that much responsibility because hey, I don't really own a house right now.
yep.
Probably my parents purchased my car or they assist, so it's not a lot of responsibility that I really need to protect per se.
Yeah.
So okay, then the question is, Maker, why would I really need to get insurance? Well, um, you definitely want to understand taxes, right? And tax
Okay.
is literally one of the biggest responsibility that we all would have,
Mm,
right? We all would have, or we all have. So that's and as you getting yourself educated on that, you can utilize life insurance to actually alleviate taxes. Okay.
oh.
Oh, she's like,
Okay.
she's
I
like,
like
oh,
how that sounds.
yeah, right. You could utilize that to alleviate taxes. One thing, okay, and also when we are young, it is the best time to be able to secure the right type of insurance because it's very, very cost effective
Mm,
for us. And the more cost effective it is for us, the better we are able to utilize it. The faster we're able to
okay.
utilize it, right? And
Mm,
now again, it just determines the type that you get. Now, there are multiple type, and hopefully we'll kind of get to dive into those type. But
yeah.
really, the earlier you get it, the more you'll be able to benefit it. And that's part of the whole wealth formula. Time is a critical part of building your wealth, right?
Mm,
So that's really why it would be beneficial for somebody to really start understanding, one, what option is there when it comes to insurance when starting out. Okay. And
yeah.
then, hey, how can I start utilizing now? Because I see myself having these, multi-million, lifestyle later on in my 30s, 40s, 50, whatever the case is, right? Want to be able to build a business that will I could walk away from or whatsoever,
Mm,
right? Build this generational wealth that everybody's talking about nowadays, so I need to understand starting now.
okay. That makes sense. And I definitely understand what you're saying about cost effectiveness because like I was sharing with you, I believe my aunt was telling me about she had an insurance policy and she had, I think, term life, and then she aged out of it. And so now the price that she was paying when she was 20 is drastically different because now she's older and she's had health issues and all these things because that's what happens when you get older majority of the time. And so I think that is really important. We can definitely go into the types of insurance now. Um, Because I don't. What types of insurance are there?
Right. No, that's good. And you the what you just touched upon is really is critical for people to understand. And with insurance as a whole, life insurance as a whole, the industry go they operate on a law that we kind of don't necessarily think about as in average individual is called a God law, right?
Mm,
And when I say the God law, it pretty much means the closer you get to seeing your maker, right, the
yeah.
more the insurance company is going to charge you because they're going to be paying out.
Oh,
Okay,
that makes sense.
they're going to be paying out a lot earlier because the closer you are getting to, you're in your 50s, 60s, 70s, the chance of them paying out whatever you are asking for it is very,
Mm,
very likely. So they're going to charge you for it. And there is no business out there that is in business to lose money.
mm,
I mean,
yeah.
it's just a simple fact, right? So, and with you touching on, the older you get, you don't get healthier. That's just natural order of life, right?
Mm,
We don't get healthier. Now, of course, you could be on your health, streak and see Mars and healthy eating and things of that nature, but just naturally, we don't get healthier the older we get,
yeah.
right? So, and those are also some ingredients that cause you to have high premium in insurance.
Mm,
But just to dive into really the option that is out there, like you mentioned, the first one is term insurance. Term insurance, you got various type, and just to kind of really, how we say this, with insurance, all insurance honestly are term. They just you know make that clear. All insurance are term insurance, but
okay.
original term insurance, you have the I usually compare it to like rented apartment,
Mm,
right? So when you're, renting an apartment, you could rent for as long as you want. You could rent for a month. Sometimes you could do a month to month contract type of thing. You could do
mm,
six a year, even up to like 20 years, right? But with term, you're on a contract base from like 5 years to as far as maybe 30 or sometimes 35 years. There are some companies that will give you a 40-year, right, contract.
okay.
So what that means is today we want to get, I don't know, $1 million policy, right?
Mm,
We are 20 years of age. We just learned that insurance is good, but we don't really have capital. We're like, man, I want to be able to protect. I see myself worth $1 million in the next 20 years, but I don't really have the capital to put in 500 or 600 a month, right?
mm-hmm.
So he sat down with an agent. They're like, you know what? Yeah, we'll give you $1 million. You know what? It's gonna be like $30 for you, right? Like,
Okay.
sure, I could do that. I could afford $30, on a $1 million policy. Sure, let's do it, right? So they lock you in, let's say, a 20-year contract for $1 million. What that simply means is, for on a monthly basis, you're paying $20 for your or $30 for your $1 million contract, right? Each month. You
Okay.
do that for 20 years.
Mm,
Okay. So right now, today we are young, we're healthy, everything is good. We're paying $20 for $1 million. If anything was to happen, depending on that term insurance, hopefully, that person really educated you and really knew about insurance, right? And they told you, hey, there are some features that you can put on your term insurance. Things like critical illness, right? If something
mm,
was to happen while you have this policy, health wise, you can get money while you're living to take care of you, right? And
okay.
they added that on your contract, or terminal illness. If anything, things like that, critical, chronic illness, they added that feature, right? Because it's very crucial that we understand that these are features that need to be added on our temporary insurance. And reason
Oh.
why, because if we don't have these features on there, more than likely we will not benefit from that term. Reason
Oh.
why, reason why most term contract end, okay, they
Mm-hmm.
expire and people are still living,
Yeah.
right? People are still living. So if you live within past that 20 year, guess what happened? You've paid that 20 or $30 for 20 years. And insurance company is like, hey, your lease is over. We appreciate doing business with you. Hey, you know what? We might, we yeah, we could allow you to do another contract with us if you want to. Come on, you know you want to. We've been friends for a while,
Mm,
right? You're like, well, I paid for a whole 20 years. What do I get out of it? You had protection, you had coverage within that 20 years.
mm,
Okay. Within that
that's
20 years, you
crazy.
had coverage. If anything was to happen, we had you. But since nothing happened, hey, let's try it again.
Now let's try it again.
Right? Let's try it again. Now, of course, and it's funny, but it's not funny because people do get to those stages, right? And they're in the 40s or 60s, for example. Like our parents or friends and things that do get
Mm,
to those stages, and now health wise they're not really good, right? Even if they are good health wise, right? And you now are looking at new contract for another 20 or 30 years, those prices has skyrocketed because as earlier as I mentioned, you're a lot closer now to seeing your maker than you were before 20 years ago. So
yeah.
insurance company is going to charge you accordingly.
That's really wild. I mean, it makes sense, but it's also really wild. Mm. But oh, I was gonna say, you said something really interesting earlier. You said that someone could take $1 million policy if they believe they're going to be worth $1 million. So, is that how insurance works? Like, you get the number, I guess you think you'll be worth in the future, or how does that part work?
Gotcha. Absolutely. So actually there is a mathematical formula, okay, to determine how much insurance that you will need, right?
Mm,
And also, once you come up with this formula, and if you are again earlier stages of your journey of building life, right?
mm-hmm,
And your calculations say, hey, right now, because of your numbers, you only need about 300,000 or 400,000 or even just 100,000, right?
mm-hmm.
um, you can go with that number, or you can actually choose a higher number that you predict for yourself. Reason because within the insurance company industry, there are max amount of coverage that an individual can get based on income,
Mm.
and also basing off their age.
Oh,
Okay.
okay.
And so an individual that's with between like 18 and like 24 can actually with a student income, they're saying they're actual student, right? They
Mm-hmm.
can get themselves covered up to like 3 million.
Oh,
Yeah,
hmm.
exactly. Right.
Okay.
So you can literally increase your net. And the beautiful thing about insurance, once you protect yourself to a certain amount of coverage, that actually adds to your net worth. I don't know if you knew that,
I did not know that.
right?
Wow. Learning so much today.
Yeah, it adds to your net worth because we and I don't know how much the audience do know about how net worth is calculated, because net worth isn't actually just the type of liquid that you have, right?
Mm,
And within real estate industry, for example, if you have multiple houses, the value of the house add together to become your net worth, right?
mm-hmm,
But within the real estate industry, most people who has these amount of house don't actually own them,
mm.
right? They are technically liability until you pay them off.
I didn't even. Wow, that makes sense though because they could still take
They
the
can
house
still
if
take the
anything
house at
happens.
any time, right? But your life insurance policy, that right when you start making that premium, like the first month, it adds to your value right away. Cause
Ooh.
why? Because the insurance company that you choose
Mm.
are on hook right when you make your first premium. They have to
Oh.
pay right when that contract is signed and you made your premium, because that's why.
Mm.
Exactly. So it's really good to understand, and it's beautiful because again, now your net worth increased to whatever it is, whatever amount that you get.
Oh
So
wow.
you get yourself $1 million.
No, for real. That's actually really crazy. Where were you when I was in college?
Right. Tell me about it. Listen, I was like, where was I 5 years ago, or even 10 years ago when I was in my 20s? For real, I would have
Yeah.
definitely utilized this a lot more. But hey, we're here now. All right.
Yeah. Wow, that's so interesting. I noticed you keep saying paying your premium instead of like I guess payment. Is there some significance to that?
For sure. Because so at the end of the day, right? We know that there is no free lunch anywhere, right?
Yes.
It's just what it is. So to pay your premium, meaning that's what connects you and the insurance company in your contract, right?
Mm,
So the contract, it starts when you go to, again, you sit down with the agent, and the agent show you all your options. You're like, I'm gonna choose this one, whether it's the permanent or the temporary, and I'm gonna be making 200 or 50, whatever, right? You make those decisions, and what binds you with that contract is you make your payment as you agree on. So you agree to do it on a yearly basis, you agree to do it on a monthly basis, you do it,
oh, I
okay?
didn't know you had different
And
options.
oh yeah, no,
Yeah.
there's definitely quite a few options that you can choose when it comes to that. But yeah, so you make your payment. On the other end, the insurance company that you with are definitely going to bind by that contract if anything was to happen that you sign with, which again, if you have critical illness, right, within your policy, you had terminal illness or chronic illness within your policy. If God forbid there was some type of stroke,
Mm,
right? God forbid there was, some anything that doesn't necessarily fatally attack your life, right? You could
hmm.
kind of walk away from. And that's within the policy. You can actually get up to 90% of your death benefit while you're alive.
Wow. That's
Okay.
that's really important to
So
know.
let's just say hypothetically, right? Yeah, hypothetically, we sat down today. You're like, Maker, my situation is this. And every time I sit down with an individual, especially coming, because my main focus is education, because that's what I
Hmm.
didn't have before, right? So I educate you on your option and make sure I understand your situation financially, right? Where you're able to actually put away comfortably towards
Hmm.
something else, right? And so once we do that, you're like, okay, right now I want to get $1 million policy, but I can't put away $300-400 a month right now because hey, I'm on a student income right now, whatever the case is. I'm like, okay,
Mm,
so we can look at temporary side, right? For now, until we're able to generate some good income and maybe look on a permanent side. And so we get you $1 million policy with all the wheels, bells and whistles, which is the living benefits, as it's called, right?
mm-hmm.
So maybe a year into it, life happened, there's a diagnosis, right? And I'm pretty sure we've come across people that have had diagnosis, walk away from it, years later, fought it, whatsoever, and they're good. They
Yeah.
have to, live to 20, 30, 50 years later, right? So there's the diagnosis. And because of that, you submit a paperwork to your insurance company. This is, what the doctors say, blah, blah, blah. And they go through and approve it, right? They approve your contract because, hey, diagnosis says you got, I don't know, this breast cancer, whatever, sickness is.
Mm-hmm.
And they approve it. So you are able to get up to 90% of your death benefit to take care of you and your responsibility throughout that process.
Okay. And is that
Okay.
like given in a check form or how does
Mhm.
it?
Yes. Yeah.
Okay.
Hmm.
Oh, so that's a good question. Do do they like check to see what you're spending the money on? Because I understand it's meant for you to take care of yourself in medical expenses, but I'm pretty sure there are people who probably try to do any and everything. So
Absolutely.
is there like a
There's a
system where
way
they have to
to
check?
absolutely. So there definitely again that will come based on the type of policy that you have. For example, with the living benefit, when you have living benefit features on your temporary, right?
Mm-hmm.
They would definitely check what type of sickness and give you the check based on the expenses that would incur, right?
Mm-hmm.
But if you had permanent, for example, and there is this feature called long-term care, and I don't know how much you know about long-term care, and it's something that
Nothing.
very, very critical that we have to get educated on. And because the misconception on long-term care is, oh, it's old people that utilize long-term care, right? Old people need to be in a nursing home, and that's something that's for them. No,
Mm.
right? Long-term care, the actual people that are on long-term care as of right now, between the age of 18 and 40, is like almost 40%,
Oh wow. Okay. How
right?
come? Like,
Because the younger we are, the invincible we feel. We could do a lot. We take more risks, right?
oh,
So
yeah.
life happens when Now I'm not saying don't take risks, don't live your life, but also make sure that you protect yourself.
Mm.
Okay, and you because so long term care, what it is really if you are not able to do daily living activity.
Mm-hmm.
Okay. And what daily living activity consists of feeding yourself, bathing yourself, right?
Mm-hmm.
Moving from the chair that you're sitting on and go and grab some juice or whatsoever by yourself. Things of that nature, right? If you're not able
Okay.
to do those simple things, right, you're able to qualify for this feature that you can add to your permanent policy. Okay, or you can actually purchase long-term care as a policy by itself. Okay,
Mm.
so you can actually add that to your permanent policy. So, and with this one, you literally, if you submit the form, it's usually a lot simpler to qualify for that, right? And you literally a 90-day process. So if you're experiencing something like this for 90 days, you submit a document, you get approved, and they back pay you. So they send you a check
Mm.
Okay, they're not sending it to the hospital to your doctor. No, they're sending you a check. And what makes this even better is it is based off of your policy. Some company will give you up to 4% of your policy, or some company will give you starting out like 2%.
Mm.
So what that would look like in a monetary thing is, again, let's go with that $1 million policy, right? We got $1 million policy, and we're young, so once we got it, we're paying like $300 because we got money. We got some respect on ourselves, right? We got money, so so but we literally have this policy for only 6 months, right?
Mm.
So $300 a month, 6 months, what's that, like maybe 1,800 we put into it, right?
Yeah.
And we have $1 million policy, and life happens in that process, and we qualify for long-term care. 2% of $1 million, what is that? That's
Mm.
like
Good
roughly
question.
20,000 we could possibly be getting, and they would be sending you a check each month
For 20,000?
for 20,000.
Wow.
4% of $1 million. Now
40,000.
that is
That's
until your death benefit runs out of money, right?
how did Oh, is this like on a
She's like,
term?
wait,
Because I
what?
was gonna say, how does it run out of money?
Well, because that percent is based off of your policy. Your
Oh,
policy is a
so
million
okay.
dollar. So you are taking that 20 from that. You are utilizing your life insurance
Oh,
while you
gotcha.
are living.
Gotcha,
That's
gotcha.
one way. There's multiple ways of doing it, but that is just one way.
Okay. Can you, I guess, give the 20,000 back? Like I know it's not necessary to pay it back, but I guess to get your policy back to a million, is that a
Gotcha.
thing?
No, that's a beautiful question, right? Beautiful question. So with it being that feature, long term care, right? That's something that you don't first you don't give back, because
Mm.
that's a feature that is attached to your policy. Kind of like, let me do a comparison that other people might know. You purchase a car, right?
Mm-hmm.
And a Bluetooth is a feature that's added to the car, right?
Yeah.
You pay for that feature, right?
Mm.
Heated seat in a car. It's a feature that comes with a car, but you pay for it. It's kind of like an upgrade, right? So it's part of it. So if you're now utilizing it, it's not something that they ask you to give back, because you get that 20,000, each month,
Mm.
or you don't have to give it back, and they don't require you to give it back. What I guess the question right now might be deriving from is, if you, let's say, borrow from your policy,
Oh,
or when you,
yeah.
right?
That's the phrase. I've heard about that.
Yeah. So when it comes on a permanent side, right? So I started out early with temporary. It's a contract. You could go up to 30, 40 years, and when that contract is over, you don't have a policy no more. You have
Mm.
options of being able to get a new policy, or not have policy. Pretty much, those are the options, right? And when people are at those crossroads, majority of the time, it's either health that allows them not to get policies, or it's
Mm.
so costly that it's like it's not even worth it no more for me to be paying for $200,000 policy and paying $300-400 a month,
Mm.
right?
Yeah.
I'm gonna end up paying way more into this than I'm actually getting, right? So that's when people get to those crossroads and decide, you know what, it's not worth it. With on the temporary side,
Mm.
so that's why on the permanent side, people rest easier because they are locked in a payment in the beginning. They're like, oh, you're paying $300, right? And you're paying that for the lifetime.
Okay.
Okay, you pay that. As long as you pay that, you have coverage, right? So on a permanent side, what makes permanent different than temporary? In the beginning, I said all insurance is temporary. Remember?
Mm-hmm.
Okay. So what separates permanent from the temporary is you're able to generate equity within your policy.
Okay.
Okay. And within that insurance industry, they call it cash value.
All right.
Okay. So cash value is something that you can actually borrow from or even withdraw from, just
Mm.
like you withdraw from a bank, right? So, and that's depending on the type of policy that you got. So within your permanent policy, let's say you've had it for 10 years, right? And you really fund it properly. They show you, hey, if you pay the minimum, this is how it's gonna look like. If you pay a little bit over the minimum, this is how it's gonna work. If you're able to max fund this is how it's gonna work, right?
Okay.
Somebody walk you through it and show you all those. You're like, okay, you know what? Right now, I'm gonna start with this. When I get some money, I'm gonna do this, and
Mm.
capitalize on really the benefit and the feature of this. So in about 10 years, in your $1 million policy, you have roughly 100,000 or even 200,000 in your cash value, right?
Uh,
Because you fund it properly. What that looks like. God forbid, within that 10 years or 10 years into your account, you pass away, right?
mm.
What goes to your beneficiary is $1 million plus that 200 or 100,000 that you had saved up.
Oh.
Okay,
Okay.
and that depend on the type of policy. The only policy that doesn't give you both, okay,
Mm.
is that policy called the whole life policy.
Oh.
Whole life policy is one of permanent policy. There's multiple permanent, but whole life is one of the many permanent policy. It's the first ever permanent policy. Okay,
Mm.
it came out back in freaking 1970. Okay, first ever permanent policy. It's the only one. If you was to die, it only give you the death benefit. If you have money
Mm.
inside your cash value, you don't get that.
And the
Okay,
insurance company
so
gets it.
uh,
The insurance company gets it.
I'm so sorry.
You're fine.
But yeah, so that's one. But on the other permanent side, you get both, right? So
What is that
let's
one called? Is that
uh
called a specific
so okay.
type?
So we have the whole life. Let's do a
Mm.
little breakdown of each, right? Whole life is the first ever permanent policy. Came out in 1970. It's kind of a fixed product, meaning when you start out, it tells you, hey, you're paying this $300. You pay it until you're either 100 years of age or until you die.
Mm.
Okay, and the interest that you will be getting is this. Okay, it's a set interest. Usually, the interest is very minimum with the
Mm.
whole life, because when it came out, it usually ranged between like 2 to 3%. Okay. And based on whatever company that's providing it, they usually add a dividend to it, right? So when they're adding the dividend, an agent could be like, oh, your policy will give you maybe 8%. But, and it's because the company gets, either dividend each year or every other year. And
Okay.
so they add it into the percentage of that product to say, hey, this product will return about 8% or 5% or something like that. Okay. And that percentage is the money that's growing inside of the policy, the cash value, the equity I mentioned
Okay.
earlier. Okay. So that's whole life. And in 1980, they came up with this product called Universal Life.
Mm.
Okay. And what made it different pretty much is the fact it became a little bit more flexible. They became a little bit more flexible in how you make payment, right?
Mm.
If, life happens that $300 became a lot, sometimes you can actually make some adjustment, right? You can make some adjustment to the payment. You can even make adjustment to the death benefit.
Okay.
Okay, you can choose how long you want to pay this policy and things of that nature. So you have some flexibility with this policy, and also the interest that the cash value grows at becomes a little bit better. It ranged from like 3 to 5, 6%, depending on the company.
Okay.
Okay, and in 1990, stock market was doing amazing, and every mutual fund, pretty much kind of like how early part of pandemic, you know,
Yeah.
everything was just going up, and it was some craziness happening, right? So in the 1990 everything mutual fund wise was just going up. Whatever company you choose, you was getting rich, pretty much, right? Insurance company came up with this product called variable universal life. Okay,
Mm.
and it's pretty much you as the investor, you are choosing where your money is going. You got your policy, you got your life, so you can literally invest in the market utilizing your life insurance policy. I don't know if you
Ah.
knew that.
No, I did not know that.
Yeah, yeah. So
Wild.
you could actually, so you're choosing what mutual fund that you want to, participate. I don't know, you want to do S&P, whatever the case, right?
Mm-hmm.
And the thing with that is, you as the investor now, you're taking on the risk, because if it's in the market, it has a potential of it going up. It also has the
Mm.
potential of going down,
Down.
right?
Yeah.
So that was the product that came, during that era, because again, whatever you chose, you bound to go up. Of course, now you know it goes both ways, right?
Mm-hmm.
But that's a product, and there's literally no guarantee with it, with your cash value being there when you need it later on, right?
Okay.
But what you'll guarantee is you'll guarantee protection as you have your policy, you make your payment, right?
Okay.
And in 2000, so that's a variable life. In 2000, they came up with the latest product called Index Universal Life.
Okay. I've
Okay,
heard the name.
huh?
I said I've heard the name. I
There
don't know
you go.
anything about
Yeah,
it.
yeah. So Index Universal Life is the latest of the permanent product.
Mm.
Okay, and pretty much just like its predecessor, you make your payment, you go through the process for selecting whatever amount you need, and your payment is determined on, just like all of the policy, your payment is determined on the quality of life, meaning if you're in a risky industry as far as work wise,
Mm-hmm.
okay, if you have a very risky lifestyle, meaning you jumping out of an airplane, you have your own private pilot license,
Mm.
risky lifestyle will cause you to pay more, because that's chance of you meeting your maker a lot sooner, right?
Yeah.
Or hey, driving record is also affected. Okay,
Mm.
family history of health, body weight index, things of
Okay.
that nature would determine how what you will be paying, right? And of course the age, right? And females usually pay less than men when it
Okay, that's
comes to
good.
yeah, females usually pay less because again, they usually live longer. limit, right?
Mm.
So, but so once your payment is determined, your policy is determined, how your cash value grows within index is based on what's going on with the stock market. How your cash value, the equity that you grow within your policy, um, is grows is based off on the market, the performance
Mm.
of the market. Now, let's not get misconfused. Your money is not in the market. Okay, it
Okay.
mirrors what's happening in the market. So, if the market, the beautiful part about it, if the market goes up, let's say market goes up 50%,
Mm.
the insurance company give you what's called a cap. Okay, so if the market goes up, they will give you up to a certain percentage. So some
Okay.
company can give you up to like 15%. Some company can give you up to 20% return on your money.
Okay.
Okay.
Quick question. How
Uh huh.
does the mirroring work? Like what
Right.
what is that?
The mirroring works because again, um, depending on, let's say, each month, right? Stock market is performed pretty much each day, right? But
Mm.
each month, the S&P return, I don't know, 50% or 20%, 10%
Mm.
average, right?
Yeah.
So based on how, because your policy is okay. How do I simplify mirroring? It pretty much just watch how it's doing and give you a return in a sense. Does that make
Okay.
sense?
It makes sense, but it doesn't make sense as to why they would do that.
Right, right. So to take it back, there's no company in business that's in
Mm.
business to lose money,
Yes.
right? Let's let's get back to that. So um when they are giving you the good return, right? Um they also are making money because you are capped at a certain percent, right?
Okay.
So the stock market could go up 100% if it does. I don't know when it's the last time in history it ever did 100%,
Mm-hmm.
but let's say it went up 100% and you get that 20%. Technically, they made 80%.
Oh,
Does that make sense?
no. But I I get your numbers.
Uh huh.
I just don't know how they made 80%. But it's
Okay.
okay.
No, yeah, no, I'm saying if the stock market, right? Stock
Mm-hmm.
market goes up 100%,
Yes.
okay? And your policy being based off of the in market, meaning the money that you're paying on your premium, right? They're
Mm.
utilizing it. The insurance company is utilizing it.
Oh, okay.
The insurance company is utilizing it, right? But they're saying worst case scenario, you will always get your money.
Okay.
Okay, so with the cap, the beautiful part about it is okay, with them giving you a cap, they also give you a floor.
Mm.
Okay, and that floor means if the market is doing bad, right, the market is tanking, I don't know, 20, 30, 40%, you will always get a floor, which means some company will say your floor would be zero, which
Mm-hmm.
means if the market is tanking, you will always have what you put into this policy. Worst case
Okay.
scenario, you have what you put in. So that's the promise they're making with you, right? Or some company be like, we'll do better than that. We'll give you a floor of 0.75%.
Mm.
So, which means if the market is tanking, you are still growing, but not at a great rate, right? You're still
Yeah.
at 0.75% growth on your money that you're putting in with us.
Okay.
Okay. So and you got banks nowadays that don't even offer 0.75%, you know,
Yeah.
on your
Mm-hmm.
money. So that's an automatically win right there, right? But
Yeah.
so now you know that your money now grows between, let's say, a 0.75% to like 15%, right? Within your index policy. Okay.
Mm-hmm.
So, and you're paying your, let's say, the $300 a month. And we've done that for X amount, let's say 10 years. We got some money inside a policy, right? Inside
Mm-hmm.
the cash value that's, let's say, 100,000.
Yeah.
And we're like, we want to do a project, we want to go into business with somebody, whatever is going on. We want to even buy a house, right? Buy a brand new car, whatever. You can call up your company, whatever company you have your policy with. Hey, I need 40,000, right?
Mm-hmm.
I see I got 100,000 in there. I need 40,000. Okay, okay. How soon do you want it? Oh, I need it like tomorrow. Well, we can do it tomorrow, but probably will 2 days from now works? Yeah, okay. I think I could wait another 2 days, right?
Okay. Yeah.
Bam, you get the check for 40,000. You do what you want with it, right?
Okay.
And with it now, with the index, you have two options
Mm.
of getting your money. Okay, you can actually withdraw that money, okay, or you can take a loan. You could borrow.
Mm.
So when you withdraw, so just like a bank, right? When you withdraw, you deplete your account of that amount,
Yeah.
right? And that's the same thing with the life insurance. You deplete your account of that 40,000.
Okay.
Okay. So now it's not advised to do so. Reason why it's not advised to do so because now when you're getting credited these interests each month, that
Mm-hmm.
interest is now based off of what you have in that account.
Oh.
Okay.
Okay.
Let's say if you got, let's say you got 10% return this month, right?
Mm-hmm.
And you had, my math is not great, so
No, I feel you. I'd be like, let me get my
let me
calculator.
get my let me get my calculator. So let's say we got 100,000 right in there, and we got 10%. So what is that? You got 10,000 uh, based off of interest.
Mm-hmm.
Now, if you subtract 40, you got 60,000 in there, right? Left.
Yeah.
Now, and you still got that 10% return that month. That 10% is now added to your 60, not 100, because you
Mm-hmm.
subtracted it at 40, right? In the industry, agents or licensed professional will recommend, highly recommend that you do borrowing, okay,
Okay.
versus you depleting your account of the amount. And the
Mm-hmm.
reason why, when you borrow, your account isn't depleted of the amount that you borrow.
Mm-hmm.
Okay. So it still looks like you have 100,000 in there.
Okay.
Okay. So if you get that 10% return, you get your 10,000 on your account.
Mm.
Okay. Now with borrowing, there is, so if, let's say if you were to ask or go to Bank of America or Capital One to borrow, right? How does that work usually? I'm just curious.
Um, that's a good question. I don't know. I think you. I really don't know. You have to come to them with like documents. I guess a reason for borrowing and proof of income. Um. Yes, that's as
Okay.
far as I know. Oh, and they give you an interest. Wait, do they? I think so.
Yes.
Yes.
You see, I'm so glad we're having this conversation because, again, this is really a conversation that's not really had,
Mm-hmm.
right, out there. And this is, yes, is, we're talking, on life insurance, but also we're talking in general, right?
Mm-hmm.
Financial. right?
Yes.
Because when you go out there, you're borrowing. When we even get out of high school, we're allowed to borrow money for college, right?
Oh yeah. Mm-hmm.
Right. Sometimes they even allow you to borrow like two, 300,000 for whatever. You know, if you want
Yep.
to be a doctor, you could borrow up to 300,000, and now
Yeah.
you got a student loan for the rest of your life
Mm-hmm.
because they don't explain what interests are, and most people don't even understand what interest is,
Yeah.
right, and how it works. But in a nutshell, right, when you're going out there, you borrowing. Of course, yes, you got to uh, ex- explain why you want the money, um, uh, your capability of paying it back, right?
Mm-hmm.
Proof of income and things of that nature, and there are interests because if they decide to do business with you and give you that money, they're like, hey,
Mm-hmm.
you're gonna pay us back this plus because we allow you to borrow this, you're gonna owe us this much more. Are
Mm-hmm.
you capable of doing that? Again, when we're in that student loan process, we just like yes, 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 sure, right? Because we don't understand it,
Yeah.
right? And then, a few years after graduation, we get that little love letter from those student loan. Oh, pay us $300. You pay it for like 30 years. You're like, wait, why is it not gone? Because it's interest,
Mm.
right? And interest is literally anywhere in the world you live at. Interest is how money works. Okay.
Okay.
That's what we need to understand. And there's this, I'm not sure if you are familiar with the rule called root of 72 or magic of compound interest.
I've heard of the magic of compound interest. I
Okay.
haven't heard of Rule 72.
Okay. So they're the same. They're one and the
Mm.
same. They're just two different names, right? And rule of 72 simply it addresses two things. Okay.
Mm.
And it says if you understand it, okay, if you understand it and you apply it, you get paid by it.
Okay.
Okay. If you understand it and apply it, you get paid by it. But if you don't understand it, clearly you won't be applying it. You are paying into it.
Okay.
Okay. Exhibit A with a student loan, right? We, sign on the dotted line. We get those student loans. And what we don't understand is that debt that we just signed for is maybe it started out with like 30,000. It's
Mm.
doubling because of the interest that is on it by the day. Okay.
Oh,
It is doubling.
it
It's doubling.
it's not like a monthly thing.
Oh,
It's
it is doubling by the day. So the
That's
root
wild.
so it addressed those two, right?
Mm.
But in mathematical formula, right? The root of 72, Albert Einstein is actually the one that came up with this. That mathematically it says you take the number 72,
Mm-hmm.
okay, you divide it by the interest that you are getting or you are paying into. Okay. So you divide it and now it tells you how long it takes for whatever money you're growing to grow or how much debt you're paying. So 72
Okay.
divided by the interest determine how long it takes for your money to grow, to double. Okay.
Okay.
So in a nutshell, it can be on a daily basis, it could be on a monthly basis, right? Because let's say if your student loan is 4%, right?
Mm.
And you have a $100,000 student loan, right? Um, 72 divided by 4 is going to take you roughly 72 divided by 4 is going to take you 18 years. 18 years for your 100,000 to become 200,000.
Wow. This sounds like a really long time.
Huh?
I said that sounds like a really long time.
Well, it's a long time if it's money that's coming to you, but
Mm.
it's not a long time if it's money you have to pay out. 200,000,
Yeah.
right? Let's say again you're a student, right?
Hmm.
You got people who are long time student. You got to go through whatever. As a engineer, you got so many years of school you got to do, right? And you don't really have that funds to start paying your student loan, right?
Hmm.
Um, Maybe you need 8 years in school. Sometimes people change their majors, right? And all of these. So 18-year might sound like a long time, but also it might come really fast, right? So
Oh,
if you're not
that's true.
making payment, right? Next, you sign a contract for 100,000. Next thing you know, it's already 200,000. You got to pay back,
Yeah.
right? So that's with it with your debt doubling. But most of the time, we're not getting those interests because most people put their money where in banks that
Hmm.
barely gets the percentage or 2%, right?
Hmm.
So if you are fortunate enough to have 100,000, it's gonna take you 18 years, but on an average, right? Let's just look at our audience for example, right? Our demographic right now. Most of us in our 20s, right?
Hmm.
Early, 20s, early 30s. Not a lot of people have 100,000 in their account
Yeah.
starting out. Hopefully, we got $200. Hopefully, we got $500, right? In there, But if your money's not even growing, literally, um, at 5 or more you're usually losing.
Hmm.
You're usually losing, right?
Yeah.
So yeah, so your money definitely needs to be growing. But so we borrow. We okay when it. I think I just went on a tangent a little bit. I
No,
really
but it's
felt
all good information. I'm
yeah.
writing it
No.
down.
I think I went on a tangent just a little bit, but really back right with the life insurance. You have like 100,000, you borrow your 40,000, right?
Hmm.
And you go to and the beautiful thing about it with the insurance company, you're not proving, hey, income. You
Oh,
just call them, right? You
okay.
just call them and be
That's
like,
good to
hey,
know.
I see that I have this money. I want to utilize the 40,000. Can I get it? They're like, yeah, you could get it in a few days. All right.
Oh.
Right. So we said we're gonna borrow it, right? Because we sat down with our licensed professional. They told us the best route to do it is to
Hmm.
borrow. We're like, okay. So, but we're like, wait, that means I gotta pay interest because I'm borrowing, right? It's like, okay, with the life insurance, it's the lowest interest you would ever pay on a loan, guarantee. It's even lower than you probably borrowing the money from friends and family.
Mm.
Okay, and that's the beauty of it,
Let me,
right? Of course,
let
unless
me
your
get some
parents,
insurance.
huh?
I said, let me go get some insurance.
Right, and unless your friends and family just give you the money and don't, want it back with any type of interest, but usually
Mm.
the interest on your uh, index. Okay, so index it usually roughly turn out to be about 1% that you pay on your
Okay.
interest on your loan. Okay, on the whole life,
That's real good.
that is really good, right?
Mm.
Whole life, the interest range between about 6 to 8.
Okay.
Okay, the interest on that. Um, and universal, I believe, is roughly around 5 to 6 around there percent
Okay.
on your loan. But so to tell you on your index, you're gonna be paying the 1% interest. You're like, hey, run me my money. I need that
Yes.
40 because I
Bring me the
decided
money.
what I'm gonna do with it. I'm gonna do an investment. I got these plans, right?
Mm-hmm.
And because you borrowing, you're not paying taxes on this
Oh.
money. Okay.
Hmm.
Mm. She's like, good. I like this, right?
Yes.
Um, so now you are utilizing this money tax free, and of course, if you're doing a business, you're making a double, and you don't have to pay it back, as we've
Mm-hmm.
alluded to earlier. So this money. you don't ever have to pay back. Now, they
Wait,
recommend you pay it. Uh huh.
so how does the interest work then if they're charging you interest? Because aren't interests usually on the payments that you make?
Gotcha. So the interest, that 1%,
Mm,
is charged on the your account, right? It's charged on your account that's in that you have with them, because
mm-hmm.
you are make just because you borrow money, right,
Yeah.
doesn't mean you stop paying into your account.
Oh, yes. Okay, I got you.
Okay, there you go. But yeah, good question. That's a really good question. So yeah, you don't have to pay it back. You use the money however you want. Now it's recommended that you pay it back because obviously when you put it back, it affect your account in a positive way,
Mm-hmm.
right? But yeah, that's really how when you can access the money that's in that cash value and do as you want, and you keep really. It's honestly the um, product within the financial space that once you set it up, it literally always goes up,
Okay.
always goes up, and never comes down.
Wow, that's amazing. That's that's really good. Oh my goodness. Okay, that was a lot of good information, and
Yeah.
I want to invite you back, but um, I want to make sure for the people who haven't been informed about insurance or want to get into insurance. So I know you were saying at the beginning, you would need to have your goal in place in
Hmm.
order to determine what type of insurance you need.
Hmm.
So can you kind of touch on what people need to look at, or I guess young adults in particular, need to look at right now if they wanted to go to someone to get insurance?
Gotcha. Well, first of all, my strongest recommendation is you want to sit down with a licensed professional
Mm.
that is not commission hungry.
Okay.
Okay, somebody that is not commission hungry and that is more mission to educate you on your option.
Mm.
Because again, young adult, young adults, and even adults, majority of them don't really know what they want.
Yeah.
Okay.
Hmm.
Sometimes you do stumble on realizing your responsibility at certain ages. It might be early, right? It might be
Hmm.
way later on down the road. You might be in your 50s, realize, oh man, all right, now I got to start setting things up, right? So sit down with somebody that is generally um, wanting to educate you on your option and really inform you on what you can do at the stage that you're at, right?
Okay.
And sometimes by them doing that might not necessarily benefit them commission wise
Hmm.
more, right?
Okay.
But if you as a licensed professional, of course, if you do a good deed, it always pay forward in the end, right?
Yeah.
So, but you sit down with somebody that really wanted to educate and give you all your options, then you can choose from that. And usually those type of people are brokers. They're not
Okay.
people that work with one company.
Okay.
Okay, that honestly would be the first step. Okay, and hey, if you want, you can definitely sit down with, quite a few, right, and
Mm.
kind of see, hey, you know what, this person really seemed pretty genuine, and they didn't just shove numbers down. They're like, oh yeah, you pay this, and or yeah, you could get $1 million and you pay this. Why? Why do I,
Yeah.
why do I really need $1 million? Um, Actually, I think I just want to start with 500. Like, why? And if somebody is not willing to genuinely answer the question, then you probably might want to, explore other options.
Okay. That makes
But
sense.
yeah, my advice to really start off, that's where you start. You start off with brokers. You start off with people that are really willing to educate you on your many options that are available. and kind of come up with some option that would best suit your need.
Mm.
Yeah.
Okay. Okay. Cool. Um. Okay. I just see we're coming up on time.
Yes.
um. Wow. Do you have like, I guess, any other general knowledge? Like, what are some questions that people should ask when it comes to insurance? Because I don't know. Like, are
Yeah.
there questions that you should ask?
Of course. I mean, again, one, you got to know first what type of policy you want to get. First of all, right? You want to get a temporary or the permanent. What are
Mm,
the benefits, right?
yeah.
Um, and will this policy be around when I actually need it?
Mm,
What does that really look like in the sense of needing it? In the sense, if there's sickness, right? Or hey, when I need to get money and do this, um, can I actually do that? Um, what features are come with this policy? How can I actually get qualified?
oh, you have to qualify for. Well, no, that makes sense. Okay.
You see, that's a good question, right? And it's not something people think about. You got to be
Yeah.
qualified? What? I thought they just take my money and then, say I got.
Yeah.
But, yeah, again, because it's a contract that you're doing with an insurance company, right?
Mm,
And when you are making your payment, the premium, they have to abide by that contract, which means even if, God forbid, you had that policy for even 2 months
mm,
and you pass away and you had $1 million policy, they would have to pay $1 million to the beneficiary two
mm.
months later, even though you probably paid $100 into this policy. Yeah. So yeah, it's definitely just like, I don't know if you whatever your my thing is always you have to know where your money is going.
Mm.
Okay, you have to know what's happening with your money. For example, we growing up, my first introduction to finance was my dad taking me to the bank. It was Wells Fargo to open my first bank account, right? And kind of walking me through that process, sitting down with an agent and things of that nature. And but most people have no clue in the process of other things, right?
Yeah.
So, and we become pretty secure with the idea of, hey, when I have money, I put it in the bank. But we don't really understand what's really happening with our money, right?
Mm.
And we must know what's going on with our money. We put our money in the bank. Is it working for us? It's usually working for the bank. The bank utilize your money to make money off of it. They don't
Mm.
get anything from you. But also, if you're putting your money in the stock, things of that, you got to know what's going on with it. Is your money working
Yeah.
for you? At the end of the day, my thing is always, what's going on with my money? Who is it working for?
Mm.
Okay, yeah. So yeah, there's definitely some question that you can ask, and again, uh, when in doubt, ask what else don't I know about this? Okay, what's really happening with? Hey, you're saying I put $50 a month. What am I getting in return for this $50 a month that I'm putting into it? Those are some simple questions we could start with.
Wow. That is a simple question. And it's like so obvious, but at the same time, not obvious.
Absolutely, yep, that's very true.
Wow. That's amazing. I did have one question because when you were mentioning, I don't remember exactly what you said, but it reminded me someone mentioned, I think it's a liability, like the different tiers of insurance. Like
Hmm.
the bare minimum is liability insurance or something. I don't
Hmm.
know.
Okay, so I think you might be thinking, if we're talking liability, we might be thinking more like car insurance.
Oh, that was the example it was used with. But they were
Huh?
talking about yeah, they were just talking about how a young person would come in to get a car and then they would get liability, which is the bare minimum versus another one. And I was just wondering what were the different types in that category, I
Gotcha.
guess.
Good question. And I'm glad you brought that up because it's beautiful. Because so it's so many people that's walking around that have insurance, right? Life
Mm,
insurance in general, but they don't have the right amount. They don't have enough, right?
mm,
For example, um going back to the car example, right? When you purchase a car, um whether it's the top tier or the
mm.
very liability is equal to or greater than the value of the car,
Oh, okay.
right? So the dealership always want the value of that car back if anything was to happen. So
Mm,
if it's